this. We're going to talk about the Greeks, and I also want y'all to understand the basics of taxes whenever you trading. You gotta know the tax basics. Okay. Now, again, the options chain is just a list. When y'all open up your brokerage account and you pull up a stock, okay, and you tap the options tab, I don't care what you trading on. When you pull up the your account and you pull up the stock options tab, this table that you see is usually going to be an options chain, right? I'm gonna walk y'all through it column by column so you never feel lost again. First of all, put a W in the chat if y'all tapped in. I want to see who all tapped in before I get started. I got to know is people locked in and listening, so I know I ain't just talking to my computer screen. Where my learners at? Because if you could learn, you can earn. What's up? What y'all got going on? Put a W in the chat if you picking up what I'm putting down. I see your comment, Miss K. Miss K says she a winner. But look, check me out, y'all. Look, hear me out. So, on the left side of this chain, you have the calls. All right? We're looking at the calls on this side. A call, ladies and gentlemen, is a bet that the stock is going to go up. On the right side, you got puts. A put is a bet that the stock price is going to go down. In the middle, running down the center like a spine, those are the strike prices. Sometimes the strike prices are going to be on the left. Okay, sometimes they might be in different areas, but nonetheless, you will know that they are the strike prices because they will look very close to where the price is at right now anyways. They won't be far from where the price is at. Okay, so to make a long story short, because I don't want to bore y'all, I want to teach y'all. The strike price is the price that you are betting that the stock is going to reach. If you buy a call with the 50, let's say you buy a call with a $550 strike on SPY. That means you think that the price is going to go to $550 or more. You are betting that SPY will be above 550 by the time your contract expires. Now, we're going to talk about the columns inside the chain. First of all, if you write, you make a shit ton of money. I don't know if y'all know or not, but your money will quadruple times 10. Like, not every time, but you know, sometimes you can see a exponential growth in your money if you are right about which direction the price is going in. Okay. Now we're going to talk about the columns that are inside the chain. Well, let's go over the bid, the ask. Have any of y'all ever traded stock options and been confused about what is the bid? What is the ask? What do they mean by last? What is volume? What is delta? Have any of y'all ever been confused about that? Or do we got a bunch of experts in the chat? Let me know. Let me know. We might got a bunch of experts in the chat. Well, it's okay. Y'all ain't got to let me know because I know some of y'all are shy. Check it out. I'm explaining to y'all what these columns mean, okay? Now, the first two that you mostly look at are going to be the bid and the ask. The Greeks confuse me, says Midnight Toker. I got you. So I'm gonna go over the Greeks. I got a whole lesson for you on the Greeks. Tonight, when you leave this live stream, you won't be confused about the Greeks anymore. Midnight Toker, I'm gonna ask you at the end of that lesson, are you still confused? Okay. Now, remember, you want to look at the bid and the ask. The bid is the highest price that somebody is willing to pay to buy that contract right now. Y'all hear me? The bid is the highest price that somebody is willing to pay to buy that contract right now. The ask is the lowest price that somebody is willing to sell it for. This is it. This is what I'm trying to sell it for. This is what I'm asking for. All right. Now, when you buy an option, you are going to pay close to the asking price. When you sell an option, you are going to get close to the bid price. There is a gap between those two numbers. That is called the spread. Am I moving too fast for y'all? Let me know. Let me know if I'm moving too fast. No child left behind, face side. No, I'm for real though. Let me know. Tracking. Okay. So we got the bid, we got the ask, and we got the spread. Remember, the bid is what you do when you are selling an option. When you are buying an option, you are going to pay close to whatever the asking price is. So whatever the asking price is, that's how much it costs for you to pay for that contract. Now I will explain why it says like 0.48. A lot of people will see that and think it means 48 cents. They'll think this means $1.25, and it does, but that's per share in that contract. Remember, there's 100 shares per contract. So that's that number times 100. And that is the premium price that you're going to pay to get into that contract, right? Now, let's move on. When you sell, you are going to get close to the bid. The gap between those is what? The spread. That spread is a cost too. So the wider the spread, the more expensive it is to get in and out. Always look for options with tight bid ask spreads. Are we clear? I want to make sure we clear before I move on. That way y'all don't be like, oh, I didn't know that in the future. Because when you're looking at an options chain and you're looking at the bid and the asking price, the difference between the two doesn't need to be wide. It needs to be tight. All right, Miss K said we clear. All good. I want to. Who else is still confused about the spread needing to be tight when trading stock options? Who is still confused about that? Let me know, because if it's one person still confused, it's 10 other people that's still confused that ain't gonna say nothing. So don't be afraid. And if you do get it, just drop a W in the chat and I'll move on. You know, this is an active live stream, y'all. We got to be active. What's a good spread? A good spread, we looking at anything from maybe a 10-cent spread, a 10 to 20 cent spread, 5-cent spread, 2-cent spread. Once you get off into the 20, it is kind of steep, but you don't want it to be, a crazy spread. That means you getting into the trade automatically negative. Who was that? Midnight? No, that was Sheila. Excuse me. But yeah. So what happens is the wider the spread, the more expensive it is to get in and out. You want to look for the tight spreads because a big spread is going to eat your profit before the trade even begins. Are we clear? The next column that we're going to look at is the last price, right? So you're going to see the bid when you're looking at an options chain. You're going to see the word ask. Now y'all know what the bid and the ask is, and y'all know about the spread. We're going to talk about this column called last that you will see sometimes because you do have customization. You can literally customize the filters that are on your options chain, and you can have it show you columns that you want it to show you. It might not always be bid, ask, last, volume, delta, and it might not even be in this order. It's customizable. All right. Now, but for education's sakes, I figured I'd put these on here for now. So what I want y'all to understand about last, this is the price of the most recent trade that actually happened on that contract. Okay. And the volume tells you how many contracts traded today. Open interest tells you how many contracts are currently active and have not been closed yet. Y'all ever been confused about high volume? What does volume or open interest mean? Do I need to say that again? We're not going to complicate things. What is volume? What is volume, y'all? Volume tells you how many contracts traded today. What is volume? Volume tells you how many contracts traded today. It should be locked in. Okay. What is open interest? Open interest tells you how many contracts are currently active and have not been closed yet. Open interest, aka open interest. This is how many contracts that are currently active and they have not been closed yet. So high volume and high open interest mean a lot of people are trading This option, that is liquidity. You want liquidity. You want that. Low volume options are hard to get in and out of without paying a penalty. I'm going to use a lemonade stand example. If you bought a shit ton of lemons and sugar and water and shit, and you trying to do a lemonade stand, and you didn't put this money into it, you didn't pay this premium price for all this shit, right? And you on a street that has low liquidity and low volume. There's no traffic. There's nobody there to even buy the shit. So now you just, you holding the bag until the shit expires. You're holding the goods until it expires because there's no volume or no liquidity. Versus the person that did this on a street with high traffic, aka high liquidity, high volume. You see what I'm saying? Are y'all picking up what I'm putting down? Now, I need to explain the 3 zones of the chain. So this is where a lot of people get confused. The 3 zones are basically in the money, at the money, and out of the money. But we're going to make this as simple as I possibly can. First of all, I need y'all tapping while I'm yapping. You feel me? This tapping is clapping. Share the live out if you've learned anything so far since I've been talking for this first 15 minutes. We haven't went over much. We are going over how to read an options chain. All right? Yeah, y'all do me a solid. Share the live. Share the live out. Appreciate you for the follow, Talking Life. Thank you for the follow, Will on the Road. Sarah Kai, thank you for the follow. Sheila, I appreciate you so much for sharing the live. See, that's what I mean right there, y'all. Thank you for the cooperation. It means the world to me. So now I will continue the lesson. I said I was going to go over in the money, at the money, and what's the last one? Out of the money. Right? All right. Now, if the stock is currently trading at 40, let's say it's trading at 548, like it is on the options chain. Right now it's trading at $548. That's right, Lorraine. ITM, ATM, and OTM. Okay. Now let's say that this stock that we looking at is at $548, right? Then if we're going to buy a call, then any call with the strike below 548 is in the money. So if we're going to buy a call and the price is 548, anytime you're looking at a strike price that is below 548, it's in the money. Y'all better lock this in. Let's not complicate this. That means that the stock has already passed that price. Right now it's 548. It already passed 540. It already passed 535. It already passed 530. Okay? These calls are more expensive when they are in the money, but they have real intrinsic value. Intrinsic, in the money. All right? Swimming in the money. They have value. Any call with the strike that is above 548 is out of the money. The stock has not gotten there yet. It ain't got the 550. It's at 548. It ain't got the 555, 560, or 565. All of these are out of the money. The price has not reached there. They are out of reach. It is out of the money. It is not there yet. All right? So, these are going to be cheaper. But they need more movement in order for it to pay off. The price needs to move and it needs to get there on time. Like not later, but sooner. So the strike that is the closest to 548, that is called at the money because it's standing right there at the price. It's at the money. That is usually where the most action is going to happen at, are the ones that are at the money. So most of the time when I teach options at Ironworth, I start with at the money options because it's going to give you the clearest picture of how options work. Okay? Y'all picking up. All I need is a W for the winners. Just, winners. Put the W's in the chat if you picking up what I'm putting down. That's just letting me know that you're comprehending it. You grasping it. It's getting through to you. Because if it's not getting through to you, I need to slow down, bring it back for the people in the back. The ladies on fire. The ladies is on fire. Where my fellas at, man? The ladies is on fire. So look, the last thing that we're gonna talk about, who is this? Requested to join as a guest. I'll let you join for a quick second because I don't usually do this. So let's see what you got going on. What about the break-even price? Should we be concerned about that? The break-even price is how much. Okay, so the contract needs to move a certain amount, talking life, and it needs to move. It's based on how much your premium is paid. It's calculated. It's baked into that price as well. I never got accepted in the live. I don't know why I didn't accept you. I accepted you. So what you might have to do is send another request, and let's see if that works. Send another request. You'll redo it? All right. So talking life. So listen, hear me out. You should consider it in your strategy. Yeah, so look, break even is the price that the stock has to reach by expiration for you to either make money or lose money. So think of it like, I want you to think of it like this. If the price is below, if it's below break even, you losing money. If it's at break even, you don't make no money, you don't lose no money. If it's above break even, you're making money. If the stock is trading at, let's say you got a call option, it's in the stock trading at $100, and you buy the $105 call, that means you think the price finna go up to $105. Now the option might cost you $300. It might say 3.00. Okay? It might cost you $300 to enter that contract, right? Because one contract equals 100 shares. So it might say 3.00, but that's 300. Either way it go. What I'm saying is your break even is the strike price plus your premium paid. I missed the damn invite, NASDAQ. I seen it, but I missed it. Going all in on SoFi calls this upcoming week, says Just Believe. Well, be careful doing that, Just Believe, you crazy son. So yeah, so your strike price plus your premium paid. You hear me? 105 plus 3, that's 108. So at $105, you still lose the $3 premium, but at 108 you break even. At 110 you making money. If you, let's say you buying a put option and the stock is trading at 100 and you buy a $95 put and the premium is $2. You see what I'm saying? You still you still confused about the break even? It's gonna be the break even basically is your strike price plus the premium paid. That's how much you need that shit to move. No, I understand. Well, yeah, NASDAQ, you can't type in the question, man. You trying to, what you got, you know what I'm saying? You can't type in the question. NASDAQ. What do y'all think about me starting to do like conversations on this channel? Would y'all think, would y'all, so, cause listen, you ain't finna, you know, I don't know NASDAQ. I don't normally do that, but I'm not opposed to it. Made 350% this week on Arndos. Okay, Just Believe. That's what the fuck I'm talking about. So look, where was I at, y'all? Where was I at? Where was we at? We was talking about in the money and at the money, right? Now, if y'all not confused about in the money, at the money, who is still confused about in the money versus out of the money versus at the money? Okay, well, and options. What's up? What's the question? Now I'm gonna go over expiration date. I think y'all got it figured out. We'll go over expiration date because that's the last thing I think I haven't went over when it comes to looking at an options chain, right? So every option got an expiration date on it. I got one. Oh yeah, midnight toker for sure. It all depends on your strategy implemented, says Batman. So yeah, Expiration date. Y'all better pay attention to the expiration date when you trading stock options. It ain't just one thing. You can't just be right about the direction. You gotta be right about the time too. Lost me, G. All right, man. It's all good, Nasdaq. I'm not finna sit here and type. It's all good. Yeah, it's all good, Nasdaq. I'm not gonna sit here and dedicate the whole live stream to you either, buddy. You feel me? I love you though. I answer any question you type in the chat. I promise I will. But anyways, like I was saying, the expiration date. After the expiration date, every option got an expiration date. Some of y'all drink milk, right? Some of y'all drink fucking milk. Either way it goes. When you go to the refrigerator or wherever you keep your milk at, when you go to get milk and you look at the expiration date, some of y'all still drink this shit even if it's due that same day. All right? You ever went and got a jug of milk? You check the expiration date for a reason, because it goes bad close to the expiration date. Is starting to get bad. Options work sort of the same fucking way as a jug of milk. All right? This shit expire like milk, not like wine. You understand me? After the expiration date, the contract is dead. It's worthless. $0. If you bought a call for $200 and it expires out of the money, you lose that $200. That's the good thing about it, though. I don't care if you got $50,000 in your account. If you paid $200 for that contract, that's how much you get. That's the entire amount that you can lose, that you're able to lose. You shouldn't lose it all. It should, leveraging 200 and risking 200 is two different things, but that's a whole nother story. All right. I go over that in my $2 course. But anyways, the entire 200 is what you could lose. That is the maximum amount that you can lose on a long option. Remember, long means I'm buying, short means I'm selling. So you can only lose the amount you paid. But here's the thing. The closer you are to expiration, the faster your option loses value every single day. All you people, crazy people that are buying these short dated ass contracts, these expiration dates that expire 2-3 days from now or next week and shit, and then you holding that motherfucker to the very last second. Like, come on now. The closer you get to expiration date, the less valuable it is going to be. Listen, it loses value, first of all, every single day that you hold in the contract is losing value. So we'll get into that when I talk about the Greeks in a minute. I just want you to pay attention to the fact right now that the expiration date is one of the most important decisions that you're going to make when you buy an options contract. You gotta give yourself more cushion for the y'all know the rest. You gotta give it more cushion for the pushing. Right? Y'all know what I'm talking about. You want it to push higher, right? Yeah, we want the price to push higher, or you might want the price to push lower. You got to give it more cushion for the pushing. All right. So if not, you're going to feel it. I promise you. So now, where was I at? Matter of fact, I'm going to just go ahead and I want to go ahead and get into the Greeks. First of all, everybody set on the options chain. That's the whole chain. We just went over the bid, the ask, the strike price, the expiration date, in the money, at the money, out of the money. We talked about volume, open interest, all that good shit. So if you understand those 8 things, you can read any options chain on any platform in the world. Are y'all ready to move on to the Greeks? Yes or no? All right, then. Let's do it. Let's do it. Let's go over the Greeks. All right, so y'all know this confused a lot of people. But it's all right. We're gonna clear the error. Can y'all do me a solid one and share the live out to your story so that other people can see it, or just go to sharing it to people on your friends list. Just go to sharing. Just share it crazy. You know what I'm saying? Share it. We sharing it. We sharing the information, y'all. You have an echo. Thank you. I appreciate that empowerment. I need to hear that so I can fix it. You know, because you go live. So how about now? Hello, fellow investors. What's up, Jonathan? How do I still got an echo? Is that Coach Cardave? Y'all ready for this? He said still got it. All right, hold on. How can I fix the echo? I don't hear an echo. Okay, thank you. That's your shit, coach. That's your shit. All right, so look, y'all. Let's talk about the Greeks. All right, so the main ones that you gonna hear about whenever you're thinking about the Greeks or dealing with stock options, you have to worry about the delta, you have to worry about the gamma, the theta, and the vega. You know how you got a car and there's many different things that you need to worry about other than just gas? Same shit applies for stock options, right? I want y'all to hear me out. These are not advanced concepts, okay? Don't let nobody make you think that this shit is complicated. You feel me, Steph? It's not. I'm glad you learning, because this shit is not complicated. That's why you learning, because we're going to make it simple, and y'all not slow. You feel me? We not slow by far. What it is they make it complicated so you can't get it. It's not complicated, though. We're going to simplify this shit. Let's make it simple. All right, now, every single person who trade options, they need to know what these 4 numbers mean. You can't trade stock options and ignore the Greeks. You have to take the Greeks into account. All right? It's a variable. You can't solve the equation without knowing the variables. All right? So, if somebody tell you that the Greeks is too complicated, they just don't understand the shit well enough to explain it, I'm going to fix that for y'all right now. You going to be able to explain it. Think about it this way, right? So every single time you trade an option contract, when you in the stock market and you trading stock options, the contract has a price. You have to pay a price to get in that trade and say, I think it's going to go up or I think it's going to go down, okay? It goes up and down constantly throughout the whole day, right? But why does it change? Can anybody tell me why does it change? What forces are moving it? Can y'all tell me? Do y'all know? Guess what? It's the fucking Greeks. The Greeks tell you exactly what is affecting the price of your option and by how much. So you want to know about how your money is making money, or if your money is making money, or when your money going to be making money, how much it's going to be making, or how much you're going to be losing, and how much you got to pay to get in, or how much how much it's going to take away every day. How much is it going to grow every time it go up $1? How much is it going to lose every time it go down $1? How much is that going to change every time it go up or down $1? This is the information that you're getting from the Greeks. This is the dials on the back of the machine. So first Greek we're going to go over is the delta. The delta answers one question. All right. If the stock moves $1, how much does my option move? If the stock move $1, I got to say this shit twice like Dr. Umar so it can register. If the stock moves $1, how much does my option move? That is it. Delta is the number between 0 and 1. So it's going to go from 0 and then it'll go all the way up to it'll say 80, it'll say 0.80, 0.90, 0.99, and 1. You see what I'm saying? And then it'll go from 0 to -1 for puts. So if your call has a delta of 0.50, that means for every dollar that the stock goes up, your option is going to go up about 50 cents, which means $50. Listen, I got to slow down because I know a lot of y'all like, what the fuck you talking about? Listen, let's make it make sense. Let's go back to the options chain, and I want y'all to look at the price right here, 560. Okay. So notice that it says 560, but the delta is 0.51. Okay. This is $5.60 per share. There's 100 shares in one contract. So if I bought one contract, it would be $560. Now, I got $560 in this trade. But what this contract is worth $560, okay? But what it's saying is, if the price of this stock goes up $1 after I bought that call, my contract is going to go up 0.51, which is $51. You feel me? All right, y'all with me? If your call has a delta of 0.80, your option moves 80 cents for every dollar that the stock moves, which is $80. So the higher the delta, the more your option is going to act like the actual stock. Deep in the money options have a high delta, and they track the stock closely. If you trading far out of the money stock options, they have a very low delta. They barely move even when the stock moves. You understand? So I know y'all be like, damn, like the price moved a lot, but this didn't move a lot, which is why a lot of people compensate that by buying a shit ton of contracts. When they buying out of the money, they like to buy more contracts because it's cheaper, but they barely move even when the stock does. So the delta also doubles as a rough probability number. You can use the delta as a probability number. If it's 0.70, you got about a 70% chance. A delta of 0.30 roughly means that there is about a 30% chance that that option is going to end up making you some money on. All right? It's a 30% chance that that option is going to end up in the money by expiration if the delta is 0.30. So this is useful information if you're choosing what contract to buy. Are y'all learning still? Are y'all learning still? That's a real question in real time. I want a real answer. Y'all keep it 1,000. Let me know. Are y'all learning still? Y'all picking it up, right? Midnight says, "Damn, that's a good way to look at it." For me, Midnight, it's one of the only ways to look at it. All right, cool. Y'all learning. So now we'll go on to gamma. We'll talk about gamma now. Since we know what delta is, we're going to go to gamma. Gamma is the one that controls the delta. So if the delta is telling us how fast we going, the gamma is telling you how fast the speed is changing. Anybody, y'all know about cars. So some of y'all don't, right? Gamma is the acceleration. If delta is the speed, gamma is the acceleration, how fast the speed is changing. So when you see gamma is high, that means that the delta is going to be moving a lot. And that means that small stock moves can cause bigger and bigger swings in your option price. So the gamma is highest for at the money options that are close to expiration. Whenever you got a contract that is close to expiration and it's at the money, the gamma is going to be the highest. This is why you see options sometimes double in one day right before they expire. The gamma is through the roof, and all it needs is a small move, and it can cause a massive percentage move in that option. So any questions? Anybody got any questions about the gamma or the delta before I go on to theta? So the gamma can work for you or against you, but for my beginners, high gamma near expiration is dangerous. Be careful. Write that down. So whenever you trade in stock options, at least you know what the hell to stay away from. Skull, you should be trying to, that's the wrong question to ask. You don't ask how much can I make money with $500. You should be asking how can you protect that money that you come into the market with? You need to be trying to protect it. Now, don't worry about how much you can make. You need to be worried about how much you can afford to lose per trade. All right, which is not much with $500. You take a small trade, small losses. You see what I'm saying? So you don't blow your whole account. This is for educational purposes only too. I can't tell you what to do with your money. I'm not your financial advisor. But if you worried about how much money you're gonna make and not how much you're gonna lose, you ain't gotta worry about catching no dog. You're gonna have to worry about a dog catching your ass. All right, so cool. Y'all got the delta. Y'all got the gamma. Can you buy a fraction of an option contract? No. Good question though, Trade Monster. No, you cannot. You can buy a fraction of a share of you can buy fractional shares of a company, but you cannot buy a fraction of an options contract. You can buy a strike price that you can afford, but you got to take the Greeks into account, which is what we are talking about right now. Glock Tool says risk management, consistency, and patience win this game without a doubt. Without a doubt. Now, Theta. Pay close attention here. Theta. This one is one that works against every single option buyer every single day, no matter, regardless of what the stock does. It don't fucking matter. Everybody gonna deal with Theta in the stock option. We got Theta hitting us in real life. Everybody gotta pass away, you know. Theta is time decay. Theta is time decay. Every day that passes by and you got an option open, right? Your option is going to lose a small amount of value just from time running out. The day traders think that they don't have to worry about this type of shit. Anyways, if your option has a theta of negative 0.05, that means it loses $5 per day per contract just from the clock ticking. Are we clear? Before I move on, I don't think I need I say more? Need I say more? Let me know. I'll say it again though, just for the people in the back that's just coming in. Right? Theta is other than the premium, this is the price of doing business. Your contract is losing value every day that it is open. You're being charged a certain amount. You need to look at the theta to see what that is. All right. Think about an ice cube sitting on the fucking counter. Every hour, a little bit of it is melting away. Think about a bucket of ice cream that you bought. You know, the day traders bought a bucket of melting ice cream, all right? And they got to salvage as much as they can before it all melts away. You didn't do shit wrong. Ain't no, like, you know, you set this ice down on the counter. You ain't do nothing wrong. Ain't nobody knock it over. It just melts because time passes by. That is theta. And this is the important part. Theta accelerates. Y'all know what acceleration means. Skullpur says, what's the difference between intrinsic and extrinsic value for theta? Is that a fucking trick question? Somebody else answer that question for me, please. I'm gonna fix the question. I can't fix your question for you, but I'm gonna say this, Skull. The difference between intrinsic and extrinsic value. Let's talk about that real briefly. Look at what does intrinsic and extrinsic, just the words alone, what do they have in common? And what are the differences between those two words? Let's just have a little quick lesson in English. Intrinsic, extrinsic. So the prefix, let's talk about the prefix. The prefix X and the prefix N. You feel me? Now the trinsic part is dealing with value. Real value and potential value. Real value versus potential value. Real value is intrinsic. Potential value is extrinsic. All right. Now, where was I? We was talking about theta. I think y'all get it though. Y'all get it. So the closer you get to expiration, the faster, you're going to get eaten up by theta, time decay. So that last week before the expiration, the value can drop dramatically even if the stock barely moves. This is why cheap options that are close to expiration are not bargains. They are fucking traps. Be careful, y'all. Be careful. You are buying a melting ice cube and calling it a deal. You buying a bucket of melting ice cream. You bought tickets to a concert, right? Same day the concert begins, and you trying to sell that same ticket in the middle of the damn concert to somebody outside the gate. Like, listen, this shit is over with. It's about to be over with. You think I want to buy that from you? It's going to be hard for you to sell that. I don't want to buy that from you. Now, anyways, let's talk about the fourth Greek, because that might have been I get a little carried away with my analogies, Midnight Toker. So, yeah. Batman is right. Extrinsic is time value. It is potential value. That's right. All right, so the last Greek I'm gonna go over is Vega. All right, Vega. No, a lot of people don't pay this no attention for real, but Vega measures how sensitive your option is to changes in implied volatility. Okay, implied volatility. You might see IV. You might see somebody talk about IV, or you might hear the term IV crush, right? Your option, you got IV crushed on the option. What is IV? What is implied volatility? That is, let's say the Chicago Bulls are about to play the Los Angeles Lakers, and for whatever reason, you think that both teams are going to score 102 points apiece. That is the implied volatility. So in the fourth quarter, when they both only got 60 points, the IV will collapse and the bet loses money, whatever, right? I don't know if that was a bad analogy, but I just know that you should know that implied volatility is how much you think this shit is finna go, how much you think it's finna move. So Vega measures how sensitive your option is to how much we think it's finna move. If the market is full of fear and uncertainty, that's what Vega is pretty much gonna tell you. So when the market gets nervous about something, like whether it's the earnings report, implied volatility spikes. Basically, we think that this shit is finna go down. Oh, it's finna go down. Oh, it's finna go up. This is the implied volatility. What do we think it's about to do? Do we think it could either come down to here or it can come up to here? That is the implied volatility. Sometimes the price don't give a fuck about what we thought it was going to do, and it just completely does even more than what you thought. Like the implied volatility couldn't be far from wrong sometimes. But when the IV spikes, all options get more expensive because uncertainty has a price, ladies and gentlemen. Us not knowing has a price. Can anybody tell me what happens when the implied volatility is high? What happens to those contracts when you go to trade in stock options and the IV is high, what happens to the premium? Is it cheaper or is it more expensive? It's more expensive. So this is why a lot of people be very careful. You can get IV crushed. Like if the IV drops, the same premium can drop too. And if you holding that premium, if you holding that contract still, it could drop. What you thought you had, the unrealized gains can drop. Now, let me not get too carried away. I get carried away sometimes. Vega tells you how much your option gains or loses for every 1 point change in implied volatility. If you buy options when the IV is already high, like right before earnings, the Vega is working against you. Even if you are right about the direction, it doesn't matter. The collapse in the IV after earnings can take more value from your option than the price move added to it. So this is why when you become an experienced trader through getting your ass ate up, right? Excuse my French, but you're gonna know you either sell the option into high implied volatility or you're gonna wait for the IV to drop before you buy anything. Vega is the reason you need to check implied volatility before you buy any contract. All right. Delta, how much does it move with the stock? Gamma, how fast is that changing? Theta, how much do I lose every day from time? Vega, how much does the fear in the market affect my option? And those are the Greeks. Learn them. These are your instruments. Fly with this shit. So painful learning without anyone, says Midnight Toker. Couldn't be any more correct. That's why I'm here, Midnight. Because I felt the same way. And I want to be that somebody that nobody was for me. Huh? So yeah, we went over the Greeks. Anybody learned anything? Could y'all do me a solid and let me know if you learned anything? All you got to do is type it into the chat. Not only does it help me with the algorithm, because it shows TikTok that when Coach Price, Ironworth Trading, goes live, His live stream is full of comments. It's full of people liking the live. They're entertained, but not only are y'all entertained, you're being educated as well. So learning is fundamental. Learning is fundamental. Root word is fun, right? Mental is the second part, but fun is the first part. Treasure right here. That's right. That's right. The etymology of the word thesaurus is treasure. What is a thesaurus? It's words. This is treasure. These are gems. Now, we're going to go to the next part. Since anybody's still confused about the Greeks. Yes, you're a great teacher. Thank you, Camille. I appreciate that so much. So, Camille, I do my best. Thank you. All right. So, yes, I learned something new about all the Greeks. That's right. Use this information, though, y'all. Knowledge is not power. Applied knowledge is power. Take this information, all right? And you know what I'm going to say. Y'all got to have the power of execution. Execute this week coming up. Execute now that you know. And if you need a refresher, this video will be available to you on YouTube. If you are, I'll make it to where only the subscribers can see it. I love supporting my supporters. I can now see Greeks for what they are. Thank you, sir. You're welcome, Midnight Toker. Ava, thank you for the crown and the flowers. So yeah, the next topic though is the biggest one for me. I love it. It's my favorite one because yeah, I deal with this shit every day. We deal with this every single day. Y'all deal with it every day too, whether you know it or not. All right. And yeah, I'm giving big shout out to Robert Kiyosaki. Big shout out to Robert, because I was a grown ass man in my 30s when I learned the difference between an asset versus a liability. No, I didn't have uncles, aunties, cousins, friends, families, grandmas, grandpas. No one explained it to me. Not in school, not a friend. And when I learned what it was, I was mad at the world because why ain't nobody told me this shit yet? Oh, I know why, because y'all didn't know. They didn't know themselves, right? What they say on Boys in the Hood, they either don't know. He said he said they either know, don't know, or don't give a fuck about what go on in the hood, face side. But no, all jokes aside, this is the foundation of wealth. We're going to take a step back from options for a split second, because like this is more important than any trade you're going to ever make. You can be a profitable trader, sure. You can make money every week in the market, sure. But you can still be broke. Did y'all know that? Because I seen it happen. Everybody was so quick. I'll read the whole thing, Midnight Toker. Read that whole book. Batman says you should go over delta gamma call approximation. Cover synthetic positions as well. Okay, Batman, I'm gonna let you do that. I'm not giving them no synthetic positions yet. They're not ready for those. You mean like the wheel strategy and iron condors and butterfly spreads and strangles and straddles and nah, not yet, Batman. You do it over there, Batman. I'm gonna send their ass over there to you. Now, now they're not ready for that yet. For real, really. Now, I ain't gonna tell nobody what they not ready for either. Y'all, if y'all want to learn that, please do me a solid. The information is available on YouTube for free. I think no one should pay for anything if they haven't maximized the free resources first. What do y'all think? What do y'all think? Why in the fuck are you paying for something and you didn't even go and look at all the free shit first? What do y'all think? Don't that make more sense? Like, I'm gonna go look at all this free shit first. And then maybe if I want more information past what I can't learn from ChatGPT or what I can't Google or from what I can't YouTube, then I'll get help. But other than that, like, come on now, look up the free shit first. If you can't understand the free shit, then get some help past that. But there's too much information in the palm of your hands at any moment. All right, now, like I said, you could be a profitable trader and still be broke. I've seen it happen. If you do not understand the difference between an asset and a liability, the market gives and your lifestyle is going to fucking take away. You're going to end up running in place. You're going to be a hamster on a hamster wheel chasing a piece of cheese. All right. So we're going over asset versus liability, whether y'all like it or not. That's what we're about to talk about on this channel, on this here channel. Who is that there on that NAD? Now, the most important two words in finances, asset and liability. We're going to define them simple as possible, because I know that if I was a grown ass person that didn't really understand this concept, there's other grown ass people that don't really understand this concept. All right. And like I said, go read Rich Dad Poor Dad, because that pretty much distilled it down to the core. So I'm gonna give you some real world examples, because this is where a lot of people get confused. Let's say you got a rental property. We've all rented out a house before, or know somebody that rented out a house or whatever. When you own a house and somebody pay you rent every month, that is an asset, right? The money comes into your pocket. Let's talk about a stock that pays you a dividend, right? A dividend is money that is getting paid to you. You getting a check every quarter just for owning the stock. That is an asset. All right. First of all, an asset is anything that's putting money in your pocket. And this can be a person, this can be a thing, or a place. A liability is anything that's taking money out of your pocket. This can also be a person, a place, or a thing. Be very aware of the people in your life that are liabilities and not assets. All right. Put a W in the chat if you heard that loud and clear. Be aware of those people that are assets in your life, and be aware of whether you are an asset to people in your life. Are you an asset, or are you a liability to the people in your life? All right. So a business that runs without you being there every day and is generating income, that is an asset. Maybe you got a book that you wrote that you can sell while you sleep. That is an asset. You want your money to be working for you. You want to own things that produce cash flow, cash accumulation. That is the whole game. That's the money that you're going to use to put into the market. That is how you can retire early. That's how you can get the fuck off the clock. That's how you can live the lifestyle you want to live. That's where the disposable income is at. But let's talk about the liabilities for a second. Your car payment, liability. Money goes out every month. Your credit card debt, liability. High interest, money going out. Your mortgage on that house that you live in. Most people do not want to hear this, but in most situations, your primary residence, where you lay your head at, is a liability if it is not putting money in your pocket. You are paying a mortgage, property taxes, insurance, maintenance, repairs, etc. Money is going out every single month. It's a hole in your pocketbook, shawty. All right? There's a hole in your pocket. So unless you are renting out rooms and using that to generate income somehow, that house is taken from you. It is not given to you. Now, does that mean you should not own a home? No, it's not what I'm saying. It means that you should stop calling it an asset when your cash flow statement says otherwise. Wall Street 55 says writing the house as a business. But I want to talk about something called lifestyle creep, because this is the silent killer of wealth for the people who are actually doing well financially. All right. This is living above your means. This is what's going to screw you. You get a raise at your job, but instead of you investing that extra money into an asset, you upgrade your apartment, or you buy a nice car, or you get some jewelry. You start eating out like crazy. You start planning your next trip. You taking trips. You buying this and that. Whatever you do with your money, y'all. I'm not calling everybody, y'all. I ain't here to call y'all out. But you start going to these fancier restaurants and shit. You spending automatically. You're like, you got it, right? But your spending expands to match or exceed your income. And that's where it's screwing you at. You start spending money, and the amount you spend matches the amount that you getting in, or you end up spending more than what you bringing in. So your lifestyle creeps up to meet every dollar that you make, and then some. And then so what happens is you are making more money than you ever have, and somehow you feel more broke than ever. This is me speaking from experience, ladies and gentlemen. I'm here to help you. That is lifestyle creep. The cure for this is fucking discipline. You gotta be tough on yourself. Like when your income goes up, when you get your money, right? The first question is not, what can I afford now? Oh, I can afford these now. No, you should be saying, what asset can I buy now? Okay? So this is the loop that wealthy people run on. You got to do what wealthy people did. It's not going to stop working just because you tried it. All right? The income comes in before they spend anything on themselves. They finna take some of this and put it into some assets. You got that mindset starting right now, Midnight Toker. Just take it. You got it. You don't need it. You got it. So you start thinking about, oh, I got this money. How can I put this? What assets can I put this in? Because the asset is going to produce more income. Think about it. Think about it. Butterfly in the sky. Face ass. I can fly twice as high. Just take a look, huh? So the income goes into more assets that you got from the assets. The assets produce more income, and then you take that income and you put that into more assets, and that is the loop that wealthy people run. That loop compounds over time. A lot of people never start the loop though, because they spend first, and then they try to invest what is left, all right? Which is usually zilch. It's usually nothing. Wealthy people invest first, and then they spend what is left. They spend what's left. So that's the discipline. That is the entire difference. Not how much they make, is how much they allocate what they make. All right, y'all, we clear on that? So before y'all spend any money for the rest of this year, start asking yourself, is this going, whatever you buying, say, is this going to put money in my pocket over the next 12 months? If yes, it might be an asset. If no, it is a liability. All right, you need to own it. If you need it or want it, you need to own if you need it or want it. That's what I'm saying. Like, figure out whether you need this or want it. Name it correctly. But don't call your shit an asset. Don't call it a liability. Don't get them mixed up. Do not call your car an asset. Do not call your jewelry an investment. Call it, it is what it is. This is something nice that you own that cost you money. All right. That clarity is going to change how you think about money and how you build wealth over time. And one last thing, y'all, we hear a lot of people throw the word generational wealth around. When you die, your liabilities don't always die with you. But yeah, they usually do though. Your car payment die, your credit card debt. In most cases, some of this should get passed down. But your assets, your investment portfolio, your real estate, your business ownership, your life insurance policy, all this shit should be passed down to your children. That is how generational wealth is built. And this is not in one generation, but across generations. That's what real generational wealth is. Every asset that you buy today is a seed. You may not get to eat the fruit tomorrow, the next week. You may not get to eat the fruit the next month, the next year. But your kids will, and their kids will. And that is why we do this work. All right. Asset, money in, liability, money out. You buy assets first. You live on what is left. That's the whole setup. I didn't even scroll. I was just running my mouth. I ain't even show y'all none of the presentation. Y'all know I do that all too often. I put together this whole show and then end up running my mouth faster than the slides. I need one of them beautiful slide ladies to just sit and change the slide when I start doing my newscasting show. I'll make a trading newscasting show. Face side. But now I'm gonna talk about tax basics real quick too. All right, because I know I had somebody ask me this question. I seen some, but they made a lot of money. Right, this lady, I ain't gonna say her name. We ain't gonna name drop, but she made some real money in the market and then got completely blindsided this year when April came around, and she ended up owing thousands of dollars that she did not budget for. And I'm telling you, the government want every piece of every winner. They want a piece of every winner. Your duty is to know how big that piece is before you close the trade, not after. That's how you know the passion is real, though. Renting out parking lots. That's right. Wall Street. That's right. But you know, I wanted to push this channel towards more towards entrepreneurship, cash accumulation, not just trading, but accumulating cash, financial literacy, not just trading, building credit, how to utilize debt and business credit, not just trading. All right. And anyways, I teach risk management, right? That's the biggest thing here that I teach is how to manage your risk. But anyways, it's two types of capital gains taxes, ladies and gentlemen. Y'all about to learn a quick tax lesson real quick. It's two types of capital gains taxes. We got short term and long term. All right. So short term capital gains apply when you buy and sell something within 1 year. That's called short term capital gains. You bought it and you sold it within 1 year. Long-term capital gains apply when you hold for more than 1 year before selling. You bought it this year and you didn't sell it until after a whole year went by. So the difference in tax rate between those two is significant as fuck. All right. The short-term gains, the ones like let's say you get in the trade this year and you close it before a full year, you got to deal with short-term gains. And that's going to be taxed at your ordinary income tax rate. That's the same rate as your paycheck, depending on how much you make. That could be 10%, that could be 22%, that could be 24%. I just seen 37%. So long-term gains are taxed at a preferential rate, like 0, 15, 20%, depending on your income. Same profit, you're going to be taxed differently. All right. So based entirely on how long you held the position. So this is why if you have patience when you are trading, it is literally rewarded with lower taxes. Yeah, Wall Street, a lot of people move to Puerto Rico just for that. You have a lot of traders who move to Puerto Rico just for that. Is Wall Street 55 who I think it is? I can't really see. I'll have to come check you out after I get done with my live stream. But yeah. For most active traders, right? We got a lot of active traders in the room. They'll tell you every trade you make in options or stocks and you hold it for less than a year is a short-term capital gain. You need to know that every winning trade has a tax bill attached to it when you pay close attention. All right. To like the fact that when let's say you close a position and you made $1,000 on that position, right? Now, that's not $1,000 that you get to keep. Depending on whatever tax bracket you in, you might keep 650 of it. So budget accordingly. I tell everybody at Ironworth Trading, when you close a winner, take 25 to 30% of the profit and put it in a separate account for taxes. Don't touch it. When April comes, you prepared. You're not surprised. You're not going to act surprised. Surprises at tax time break people. Now, I'm going to explain the wash rule. Anybody know about the wash sale rule? It also I done seen this catch people off guard and it cost them real money. Y'all ever heard about the wash sale? The wash sale rule? I'm going to type it in the chat real quick. The wash sale rule. If you sell a stock at a loss and then you buy the same stock again within 30 days before or after that sale, the IRS will not let you claim the loss. All right. They call it a wash sale. That means that the sale did not really count for tax purposes. All right. So let's say you buy SPY at 570. We know it ain't at fucking 570. So let's just say 770. And it drops to 750. And you sell so that you can cut your loss, right? Cool. But then 2 weeks later, you see SPY bouncing and you buy it back. The IRS just basically said you cannot use that loss to offset your gains. That loss is disallowed. And when the window is not just 30 days after the sale, it's 30 days before and 30 days after. So that is a 61-day window where you gotta be careful. If you want to take a loss and claim it on your taxes, You cannot buy the same security for 30 days after selling it. You can buy a similar security, like a different ETF that track the same shit, but not the exact same one. Hey, Monique, how you doing? I hear about it, but do not understand. Basically, after you sell it, be careful buying it back if you wanted to count on your taxes. Like, you can do it, but just know that you ain't gonna be able to count it as a loss. See, sometimes your losses can help you because you can claim them on your taxes. Yeah, you can claim your losses on your taxes. Let's talk about the losses for a moment, because that's the silver lining. A lot of people ain't know that. Your trading losses offset your trading gains dollar for dollar. So if you made $10,000 on winning trades and then you turn around and lost 4 bands on losing trades, how much do you pay on taxes? Doom, 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 Y'all ain't gonna tell me the answer. You only pay taxes on $6,000. That is called netting your gains and losses. So if you're, like I said, if you made $10,000 on winning trades and you lost $4,000 on losing trades, you only pay taxes on $6,000. That is netting your gains and losses. If your total losses exceed your total gains for the year, meaning you had a net losing year, calm down, TikTok. All right, let's say you had a losing year. You can deduct up to $3,000 of that net loss from your regular income. Did y'all know that? And the rest of it gonna carry forward to the next, to the following year, and it'll offset future gains. Did y'all know that? See, a bad year in the market actually has a tax benefit. It ain't really comfortable when you in it, but it is real money back in your pocket. All right. Oh, y'all with me? But if you trade in index options like SPX, or if you trade futures, for those that trade futures, these type of instruments qualify under something called Section 1256 of the tax code, and that gives you a 60-40 split. 60% of your gains are automatically treated as long-term and 40% as short-term, no matter how long you held the contract. Even if you day traded it and held the shit for 5 minutes. For all you future traders, or if you trade in SPX. Yeah. So that 60% at the long-term rate is a significant tax advantage over trading individual stock options, which are always taxed at short-term rates for most traders. If you are active in the market and you have not looked at SPX options as an alternative to SPY options, then the tax treatment alone is a reason for you to do your research. I'm not a CPA, y'all. Everything I just shared is educational. I don't know your tax situation. That's something you need to discuss with a qualified tax professional. What I want to leave you with tonight is awareness. Know that taxes exist. Know that short-term gains are expensive. Know the wash sale rule. Know the $3,000 loss deduction, and set money aside every time you making money. If you got that type of discipline, it's going to help you. It's going to save you from real pain. All right, we're going to land the plane now. We're going to land the plane. We're going to land the plane. Land the plane. I'm going to keep it real. I'm going to keep it a buck with y'all. This is important, not because it is the most technical, but this is because we are human. All right, I think my sound went out. Can y'all hear me? Mic check 1 2 1 2. All right, cool. So the market is a mirror, y'all. The market is a mirror. Everything I taught y'all tonight, the options chain, we went over the Greeks. Well, we talked about assets and liabilities. I just went over taxes. But all this information don't mean shit if you can't control what happened between your ears when the real money is on the line. The market does not take your money. You give it away. And you give it away through emotions, all right? So, again, the market is a mirror. It is going to reflect who you are when you under pressure. It's going to show you whether you are patient or if you impulsive. Are you disciplined or are you reckless? Are you a confident person or are you fearful? You cannot fake your way through a live trade, y'all. This shit is going to pull up the real you. The real you is going to show up. And if the real you has unresolved issues with money, with fear, with your ego, the market is going to find it and it's going to charge you for it. So fear shows up in two ways. All right. Fear shows up in two ways. I'm going to help y'all out. When you in a trade and you making money, fear can show up. You in a winning trade and fear shows up and you get scared and you get out the trade because you're afraid of losing money. That is fear. Scared money don't what, y'all? Scared money don't what? I just want to make sure we all on the same page. I don't want nobody to say scared money don't lose money. Scared money don't make money. That's right, Monique. It don't. Scared money don't make money, Midnight Toker. We know this, right? So that's right, Camille. That's right. Y'all know what's up. That's what I'm saying. So we got to keep that in mind, that fear shows up in two ways. Fear of losing and fear of missing out. Fear of losing makes you sell too early. You had a winner. You took it off at $50 because you was scared it was going to go back down. Then it went up to $400 more. You could have made so much more money. So fear of missing out also can make you chase some shit. You buy something that then already moved 50% because you are afraid that you missing out on the rest of the move. Yeah. And then it didn't give you what you thought. So fear is the emotional response to uncertainty. Fear is the emotional response to not knowing what the fuck is about to happen. So in trading, uncertainty is constant. You're gonna constantly be uncertain. If you cannot get comfortable with uncertainty, I'm not gonna tell you to control your emotions because that's fucking stupid. I'm not gonna tell you to trade without emotions because that's fucking stupid. You can't do that. You're human. You got emotions. Learn to be comfortable with your emotions and work with them. Understand what they are. Know what's going on. Because if you can't get comfortable with uncertainty, you will be uncomfortable in every single trade you ever make. The cure for fear is preparation. Proper preparation prevents poor performance. If you have a plan before you enter, a stop before you enter, basically, hey, if the price gets to this level, I'm getting out. All right? You already determined that before you got in the trade. You already determined where you was going to get in before you got in the trade. You already determined the target, the price target before you got in the trade. When you got a plan, fear has less room to actually operate. The second enemy is greed. Greed is what's going to keep you in a trade. Greed is going to keep you in a trade longer than you should be. You had $400 profit on the trade. Your target was $400, but you just stayed in it a little bit longer. And then it reversed and became a $200 winner. And greed said, you know what? It's going to go back to $400. And yeah, it went down to $120. So that greed that you had became hope, and fucking hope became a loss. Hope is useless. Were you watching me last week? Midnight Toker. Man, listen, for real, I done been there and done that. So that cycle is one of the most common patterns in retail trading. That's how I know. So your target is your target for a reason. When you hit it, take profit. Even taking the piece of the partial profits is not a weakness. It's you being disciplined. Revenge trading. I'm on y'all ad. Revenge trading. That's the third enemy. You take a loss. It hurt. It was a real loss. Maybe it was a setup that you believed in. Maybe the market just did some unexpected shit. But whatever the reason is, now you down and something in you, right? Your ego, your pride, you feel disrespected. You like, man, ain't no way. I'm about to get my money back. I'm about to get my money back. I want y'all to understand something. You will never get that money back. That money is gone. I ain't saying you're not gonna make more money. I'm saying that the money you do make is not the money you lost. It's more money, it's different money, but stop thinking you can get your money back. That whole concept is crazy. I'm about to make my money back. You ain't making shit back. That ain't even your money that you making back. You lost your money. It's gone. You gave the market your money. Now, when that happened to somebody, they immediately jump into another trade, an even bigger trade, trying to get their quote unquote money back. They trying to show the market who in charge. But hear me out, y'all, and I'm going to save you a lot of money. The market does not know your name. It don't give a fuck that you lost. It cannot be punished. All right. So you revenge trading, that's not a trade. That's you being emotional and you dressing this shit up like you doing something financially and you're not. It almost makes the situation, it does make the situation worse. Because one bad trade becomes two bad trades. Two bad trades become three bad trades. And by the end of the session, you done wiped out a whole week's worth of money. You done wiped out a whole week's worth. You ain't like, you said you ain't gonna lose this much this week, and you done lost that much in a day. So learn how to walk away, learn how to reset and come back. And I'm pretty sure y'all done heard this shit a lot. It ain't, it shouldn't change. That's the truth. The truth is going to repeat itself. It's be the lies and shit that stick out like a sore thumb. Now, FOMO, fear of missing out. Somebody on TikTok showed you some shit and you feel like this is a social media disease of trading, FOMO. You see everybody talking about some shit that's up 40%. You see screenshots. You see people making all this money. They excited and you buy it, but you buying it at the top. Let's use Bitcoin as an example. Y'all think people buying this shit do y'all think a bunch of people buying Bitcoin up right now while it's down $60,000, $70,000? No. They gonna wait for it to get back to 100, 110, 120, and then they gonna be starting to, when they get 140, 150, then they gonna start to try to get in. I'm like, this is just the normal thing. This is what happens. Somebody says, once you pass an eval, are you required to take profits or can you let your balance grow? Now, once you pass the evaluation, you gotta stay in that evaluation. You can't you gotta take profits, and you can't lose in there either. And it also depends on what prop firm you trading. They not buying the dips. No, they not, peptide nurse. They should be. No, they not. They not. They gonna have FOMO. So that's not trading. That's handing your money to somebody who was smarter about when to enter. You just gave your money to somebody who was smarter about when to get in. The setup was gone. Your trade is to find the next setup, not to chase the last one. Every time you feel the urge to chase something because you see other people winning, that's FOMO. And FOMO is almost always intense right at the peak. So that's not an accident. That's how the market shakes money from the impatient motherfuckers and put it into the patient people hand. Now, another one is overconfidence. Overconfidence is a real thing because when shit going too good for you and you making money in the market and you think you got this shit figured out, I don't need you. I don't need him. I don't need her. I don't need this. I don't need that. Face ad. You think you got this shit figured out because you had 3 good trades in a row. You made money all week. Now you feel like you got it figured out and you put too much dip on that chip. You break all your rules. Huh? You put too much money on it because you feel like you got it figured out. So now you dropping 5,000, 6,000 on it. You skip the checklist. You start taking setups that you normally would not take because you've been on a roll. Butter baby. Butter cookie. But look, Look, the market gonna reset your ass. You ain't gotta worry about catching no dog. You gonna worry about a dog catching your ass. For real. A winning streak. Somebody having a winning streak, that's one of the most dangerous times in your trading career because it breeds sloppiness. All right? The rules that protected you start to go out the window once you start winning a lot. So be careful, like, because they exist there for a reason. But the rules that protect you exist because they were written in the blood of losses. Do not abandon them because you got lucky for a few days. And then the last one is hope. This is the enemy, ladies and gentlemen. I rebuke it in the name of the, you know what I'm saying? I rebuke it. Hope is when your stop loss gets hit and you don't close the trade because you believe it's going to come back. Oh, I believe it's going to come. I'm going to hold it a little bit longer. That's hope. That's hope. And hope is not a trading strategy. I don't care how much hope you got. You cannot, that's not going to work for you. The market is telling you through price that your thesis is wrong. Okay? Your stop loss is information. I was wrong. This is not going the way I thought. It's time for me to get the fuck out and reassess. When you move your stop loss or you take it off, you do not want to take the loss. You scary. You are not letting your logic override the hope. You are letting your hope override the logic when you do dumb shit like that. And hope in a losing trade will turn a small, manageable loss into a catastrophic one. All right? Moving your stop loss out the way is like having a bodyguard, and danger is about to attack you. And instead of you allowing the bodyguard to protect you, you are moving the bodyguard out of the way or firing the bodyguard and allowing yourself to take on danger. So start writing down the trade before you enter. That's what a disciplined trader looks like. Write down the entry price, the stop loss, the target. You need to honor the stop. You need to honor where you was gonna be wrong at, and don't hesitate to honor it. Not because you want to lose, but because you understand that protecting your money is more important than making it. Believe it or not. So they size down after the losses. Don't give up. That's what you want to do. That's what a profitable trader do. They size down after the losses. They know the difference between a trade that lost because the setup failed and a trade that lost because they broke their rules. You need to start to journal. If you're not journaling, that might be a problem too. You journal every trade, not because you're celebrating the wins, but you want to learn from the losses because you don't want to repeat the same mistake. You want to rinse, wash, and repeat what's working and cut the shit that's not. So the goal is to what? Y'all, to be right more than you are wrong. This shit ain't about predictability. It's about probability. You need to cut the losers fast and let the winners run. That math done consistently is going to allow you to build the account. If I lose a small percent, okay, every time I lose, I'm only losing a little bit. When I do take some wins, they're going to wipe out the losses. One win, wipe out 3 losses. So win-win. Okay, 3 wins, wiped out 9 losses. That's how you want it to be. So this is my challenge for y'all. It's my homework. Pick one of these enemies, and whichever one you recognize in yourself the most, in your next 10 trades, every time you feel that shit starting to creep up on you, name it out loud. Whether it's greed, be like, you know what, that's greed talking. Oh, that's FOMO. When you can name it, you damn near got power over it. When you can't name it, then it got power over you. See what I'm saying? So the market belongs to those who master themselves first. That's what I mean by built different. That's what I mean by iron sharpens iron. That is the Ironworth way, y'all live. You go get to work. Y'all got work to do, ladies and gentlemen. Y'all got work to do. So if tonight added value, if you learned something, share this channel, share this page out with some people. Tag some people in the comments right now who need to hear this. And if you want to go deeper, join my community on WAP, grab a copy of my book. All right. My mentorship is also available. The link is in the bio, y'all. Let's build. Let's build. Let's build. All right. Y'all enjoy the rest of y'all night. You're welcome. Peace of mind. Yeah, good night, y'all. Good night. Say good night for y'all leave, though. They help me out too with all. I need all the comments I can get. Before y'all leave, let me know what city and state y'all listening from too. I like to see how many people from all over the nation. You know, I'm like, damn, we got people from all over the nation in. Have a good night, Coach. Good night, y'all. I'll be back again tomorrow. We got Arizona in the building, Michigan in the building. Okay. ATL, we got ATL, Denver, Colorado in the building. Okay. You see, it'd be people from all over America in the live stream, y'all. I love it. You're more than welcome. I'll catch y'all again tomorrow. I'll be here tomorrow, same time. We're gonna see what we got going for the rest of this week. We're gonna get prepared for this week. I got a few stocks I want y'all to look at. I'm gonna give y'all my stocks that I'm paying attention to. Minnesota in the building. About maybe 10 o'clock. Yeah. Please don't make me put no time on it, Carlito. Turn the notifications on. Hey, y'all, hit the notification bell so you don't miss another live stream. I am random as hell. I will tell you a time, and then I'm going to be late, and then I'm going to look crazy. Right? So I don't want to give you no time. How about just hit that notification bell, and you will get notified. I know you might be doing anything at that moment, but I got y'all, though. If you missed the live stream, I will put the replays up on YouTube. So this video should be available on YouTube. All right. If anybody want a further conversation, inbox me. My DM is open. Hit me up. Get up with me. I'm also willing to help you. If you didn't understand anything and you want to learn personally, I'll hold your hand and walk you through it. All right. It's okay. I got you. So don't be afraid. Just inbox me. All right, y'all. Good night.